First rates, let's take it from there. And the first rates, Tuesday morning on your screen, Nifty, the Sensex, and the breadth. The breadth is looking strong, Nifty is looking flat, Bank Nifty is looking absolutely flat. Range bound, pause, consolidation, choose the word you want to use. Markets aren't going anywhere for them. Let's move away and then let's focus on metals, because that in a sense was showing signs of excitement and inertia. Only space, if I may say, yesterday did show a scope of some standout mover. So that is a bit of uptick in metal stocks. The BSE metal index is off to a decent start. But Tata Steel, JSW Steel, JSPL, all of them are off to a decent start. Hindalco, by the way, is looking very strong. When I say very strong, about 1% higher. Let's look at Escorts, the only number I can see from the auto basket where numbers have just kicked in and numbers are also due today. Then you want to look at Maruti. Now numbers are clearly not something which markets have liked. 50 rupees already down for Escorts. Maruti down another 100 rupees. So autos, I'm afraid, are not off to a great start, irrespective of what the big picture scenario is.
Yeah, autos might not be off to a great start, but at least the broader market is doing cartwheels yet again. There's 1400 on the advancing side versus 240 on the declining. So the market breadth is quite strong. But in terms of individual movers, result reactions on KEI are down to 5%. IRB has started on the back with Sumitomo Chemical as well, and DLF on account of that large trade that was happening. That stock is opened with a cut of around 2%. You also have Power Grid, which is down. It was a bit of a muted show. The sweetener of bonus is not able to propel the stock price higher. It's holding out with a cut of almost 3.5%. What else is happening in the market? Well, on the gaining side, it's metals, of course, which is taking the center stage. So apart from Hindustan Copper that saw a massive rally yesterday, that continues to build on gains. So we're watching out for that. And in terms of the other news pieces and stocks to watch out for, a whole host of counters from the broader markets like Suzlon, IRFC, etc. are doing well. So a lot of stock-specific action is what we are witnessing, Aman.
Yeah, Bajaj Auto as well in the spotlight on the back of its auto sales numbers, just flashing on the bottoms of your screen at about 3.19 lakh units. It has come in lower than what it was just on a month-on-month basis, as well as the 3.5 lakh units that it clocked in on a year-on-year basis. So there has definitely been a slowdown. The stock price just sort of digesting that news. Yeah, Escorts Kubota as well has been a bit disappointing in terms of the auto sales numbers. And you've got the airline companies, the jet fuel prices being hiked. So they're in the spotlight. Ease My Trip acquiring 3 travel tech companies. You've got Naveen Fluorine as well, as we've highlighted, where you've got a resignation coming in. Let's find out what our chartists make of the first trades trickling in, as well as some of their top recommendations. And Kunal, taking a look at the screen, what's your outlook, and share with us your first trade?
Yeah, so it's again a flat opening for the index. Bank Nifty is showing a lot of more better momentum than what we've seen earlier, at least in the last 1 or 2 weeks when it had been more sideways. So hoping that many of the private sector banking stocks would start to fire up. ICICI Bank is something which I would look to trade in the open. I think if I'm not wrong on the futures, the stock has come back about that 1000 levels. This could be a possible swing breakout for ICICI Bank. So would be keen to buying the stock for an expected target of 1040 plus.
Okay, that's ICICI Bank that Kunal is punching in as his first trade. What about you, Naresh?
Continue like NMDC, the stock has seen good volumes, could see follow-up price action over the next few sessions, expecting a bounce back towards 125, 130 in this one.
1% of equity, that's what has happened for the DLF stock, and the stock today, because of that block deal, I think is slightly under pressure. Sailesh Ban joins us, CIO Equity Investments with Nippon India Fund Management. Sailesh and me have interacted for years now, and I've really admired the way he's able to identify some mega trends. I mean, one of his big identification was when he bought into domestic pharma, then he bought into QSR. And I've been told right now that Sailesh is getting very age conscious. Just because he's getting old, he thinks the next mega trend is going to be picking up a trend when it comes to old age and senior living. Sailesh bhai, is it true that that's the next mega trend you are betting on? Bet on old people, bet on senior people, and identify their needs? He's not ready. I thought that was a good start.
Or maybe he just didn't want to answer that question, so now they're saying audio has cut.
I think that was a good start. I know he's
It
buying
was a
that mega
great
trend.
start, but nonetheless, it's been an okay start.
I thought
for
it
the
was
market as
only
well.
about women when you ask about age, it gets slightly rude. Never thought Sailesh Ban would never react to it.
Well, we live and learn, right? So we know never to ask that question to Sailesh again because either it's him or the telecom that there is some glitches. But I think we have him back. Nikunj, you want to pose that question again? Okay, we don't have him back yet?
We don't have him.
Okay, so let me just talk about some of the stocks which are actually buzzing around in a trading session right now. Oberoi Realty, apart from DLF, is on the back foot, so a cut of around 4.5% coming in there. It was a weak show from Oberoi Realty this time around. Power Grid is also seeing a cut of around 4%. There was a massive rally that happened in Power Grid last week. In fact, Nikunj just wanted to talk about NTPC and the rest of the power stocks. We were just discussing how there are a lot of tailwinds in terms of dividend yield for these companies. The fact that they're looking at unlocking their renewable arm as well. But do you think it's getting a bit heated now? Because we have always seen these false starts happening with public sector entities.
No, Nisha, this time it's been a near perfect start for NTPC. Now, okay, you look at the 10-year track record for NTPC, it has not created large amount of wealth. Last 2 years, and that's about it. Otherwise, NTPC had its own issues, whether it is ESG or government supply or which way the entire electricity space was moving. But a 40% move in NTPC, I think this time around, I think is realistic. Electricity demand is surely going up. The sector cleanup has happened. Discoms are not in such a miserable state. And you know that a word which you loosely use, bijli ki chori, that seems to be passe now. So if you don't pay, you don't get bijli. I mean, they're as simple as that. Government is very clear that if you don't pay, you really don't get power. And when these stringent laws have been adopted, states have been forced to muscle up their activity on ground. So transmission, distribution, a lot of things have actually changed for the entire electricity sector. Sailesh Ban joins us now, CIO with Nippon Asset Management. Sailesh bhai, good morning. Thank you for joining us. Did you actually miss my first question?
No, actually, I missed out the first question.
You missed out the first question. Okay, I'll start with markets and then we'll talk about mega trends. But what is your view on the market? Do you think the summer rally of 2023 is real, and the Indian markets have long way to go before we week out, whether because of valuations or whether because of euphoria?
See, if you look at how the markets have rallied and run up in the last few months, clearly there is a case that valuations certainly in pockets are getting stretched. So even though longer term, the long reforms which have happened, the medium term opportunity for India remains very strong. But there is a case we are finding that in a lot of pockets, euphoria is getting built up, especially select pockets where mid-sized businesses or the IPO frenzy which is building up. So there are pockets in the market which are clearly getting into the zone of, as you call, some frenzy where valuations don't make sense. Larger caps within the space appear to be very sensibly priced and offer possibly the best available risk reward in the marketplace versus other categories today.
The sector which you track with the magnifying glass, and you've created huge amount of wealth for investors, and that's pharma. It was a great 2020. It was a terrible 2022, and it's turning out to be a decent 2023. What is the trend in pharma? And if you can be slightly more descriptive here, Indian pharma versus global pharma, generic versus API, what are the trends you are witnessing?
See, very simply, if you look at this particular space, it had, with a very low base of the last 12-18 months, is starting to come back strongly. Directionally, the long-term, medium-term opportunity in this space is, very significant, because possibly whatever we talk about in terms of younger demographics, India also has a very large 50-plus population, as we all know. So directionally, the sector from a demand perspective is very well placed, significantly on the domestic branded side of it. US, which has been a challenging market for the last 3-4 years, is actually now turning out to be interesting because there is a lot of price increases happening in select pockets there. There is a lot of shortages in some areas, and it's certainly come back as a strong, I would say, a temporary shorter term opportunity for a profit point of view. But the longer term main structural opportunity is the branded generics market in India, which just continues to evolve, continues to grow, and it is still significantly underpenetrated from any way you look at it. You look at the chronic side of the nature of the market, which all of us know. I think that also leads to a fact that there is a large part of challenging disease structures in India, which needs solutions which are really, really long term. So I think, can this space do what it did in the last 20 years in terms of volume growth? I think that possibility exists, and that is why this sector, after underperformance in the last 12, 18 months, where valuations have also become very good, I think is well placed. Raw materials, which were a big concern area because costs had shot up dramatically. I think with the fall off in chemical prices globally, I think the benefit of lower raw material prices also coming in. So all in all, very good valuations, very sensible price to earning multiple for these businesses, and strong or large medium term opportunity for growth. So when you look all of this together, I think the space looks interesting. Other area within that, you talked about APIs and all. Today there is a challenge in terms of API pricing generally, because they've come off from the extremely high profitable levels which they were a couple of years back to normalized profitability. I think within the API space, the right to win is with businesses who have created the right cost structure. Are they in bottom quartile in terms of costs, and have they scaled up in specific products which have that advantage? When you manufacture at that scale, your costs really come down significantly. So I think only in select areas where you have built the sizable cost positions, I think that is where, and those set of businesses in APIs will do well. Regular API businesses will have fleeting profitability, which depends significantly on raw material price changes, which may not lead to long-term returns to investors.
Okay. Banks is where everybody is excited about growth and the underlying construct of the economy. But do you think banks is more like a consensus view now? And the view with any consensus is that you're not going to make splendid returns.
So, very rightly put, yes, it is a consensus view, and and these are very large part of indices themselves. But what is interesting is if you split the market into good growth and good valuations, this is one space which stands out along with pharma and power and utility space. And here the construct of the banks is, in a way, the ability of them to compound still remains, because the whole investment cycle and all that is in front of us. So in the large cap space, this is one space which has disproportionately attractive risk rewards versus normal. And the balance sheets, as you all know, have been very strong enough. Yes, it's consolidating more than usual. Other parts of markets are performing. But if you look at it, the last 5 years have been the banking story in India effectively, right? So I think after consolidation, banks will, in all probability, become important leaders, along with pharma and power sector as important categories to play in.
Why are utilities doing well? Normally utilities do well when there is nervousness in the market, when interest rates are likely to come down. These are stocks, like Buffett says, they can keep you rich, but they don't make you rich.
Yeah, so it's an interesting way of looking at utilities. Interestingly, in India, growth is coming back to utilities, especially the power utilities, because of the energy transition which we are under. So in the last 10 years, growth rates were very moderate, low single digit. There's no great capacity addition and all that. But if you look at the way India is transitioning in its energy mix, where you have nearly 50% of energy in the next 10 years wanting to come from renewable, I think the ability and the investment opportunity of those utilities is very, very strong. And they become effectively medium or mid-sized growth businesses. So they are no longer the slow growth or low growth businesses, and the valuations for that growth, that visibility, are still very, very low. So I think it's a cyclical change which can last for 5-10 years in terms of growth rates in utilities, or power utilities especially, will be way stronger than they have been in the past decade. And as you know, the size of these markets are very, very large. We are looking at billions and billions of dollars of investment happening, and there are only a few real good quality balance sheets in India who can actually deliver this. So utilities actually are a good growth story rather than just value plays in the market.
Interesting that you're calling utilities not just a value play but growth stories as well. And the other growth stories where you seem to be invested is the entire consumption and leisure theme, because you're right in Indian hotels, a chalet and EIH, etc. in your portfolio as well. Talk to us about what's your view there, because I also see Zomato, etc. and even ITC for that matter.
So interestingly, if you look at the sectors like hotels, which were completely mispriced a few years back because they had a very bad cycle, presented very good opportunities to participate in. And the focus on there was the real capacity creation has been very slow in the last 5 years because of the problems of the past. And hence, as demand recovers, you get better pricing. I think we are possibly seeing very good pricing for hotels, and the ARRs are very good for the particular space. And the medium-term opportunity also remains good because now you're getting back to growth, getting back to investment for the next few years. I think this shortage or supply shortage problem in hotels, I think, is here to stay for the next 3-4 years because any new capacity creation takes that time to come through. The second part you referred to was new age businesses. I think there are some new age businesses which have a right to win and where valuations are reasonably sensible, at least sensible in the sense that they are back to profitability and you can allow to or look at gauging what's possible or what kind of cash flows those businesses can generate. And the intensity of competition is completely eroded there. So some select right to win businesses are appearing in the new age space, which have fairly long opportunity in India to participate. I think those are spaces which look interesting, and consumer and food tech businesses are some of these.
Okay, fair enough. What about your outlook in terms of looking at the defensives? In a market such as this, do you believe that one should be really cushioning the kind of volatility that we've seen by parking their money in sectors like, say, FMCG or pharmaceuticals?
Yeah, so it's an interesting point, where, the whole way, we have seen a one-way rally in the last few months in the markets. In fact, when you look at broader valuations, there is, if you segment and see, certain pockets of the market are showing that froth which is there. Our approach in this environment is to, move money out of the expensive, frothy parts of the market, which are clearly less than 5,000 crore market cap businesses, or maybe in select manufacturing engineering businesses where you are valuing the moon already today in the part of the cycle. And I think from these, you move to large established utilities side. You talked about banks or areas in consumer where, at least in select spaces where consumer valuations are a little more sensible, I think those are the spaces which are there. The earning trajectory of these spaces is good. And even if there is a little bit of premium valuation there, the defensiveness they provide is certainly much stronger than the frothier part of the market. So I think there is a time to recalibrate risk. And I think when everything is going good, I think the ability to recalibrate risk will be important in retaining the wealth you have created over the last few years in India.
Talking about the frothiness in the market, and what comes to my mind is the recent listings that we have seen in terms of IPO, starting with listing gains of 80, 90, 100%, big subscriptions coming in. Does it make you nervous at all? Because the last time we saw this frenzy was the entire manufacturing theme when Keynes, Dixon, all of that had got listed. What's your view on manufacturing as well as the IPO frenzy?
So let us look at, say, the IPO frenzy which is happening, right? And if you look at the valuations at which these companies are coming themselves are fairly rich. And then on top of it, you're seeing some of these businesses getting listed at 70, 80% higher gains. I think this is more a reflection of the froth and frenzy than the quality and the longevity of those businesses. We have seen a lot of businesses, the percentage success rates of these IPO businesses primarily because once they are in the market, once they are tested, once they grow, there is a scale-related challenges which comes to a lot of these businesses. So I think the risk of owning some of these businesses is way higher, and versus the return expectations one can run with. So there certainly is meaningful froth. Coming to the manufacturing side, well, we are at a cusp of an important manufacturing journey, and I think in the next few years, certainly this is an important theme to play. But what we are finding is when you look at select pockets, because there are the good part or the bad part is there are lesser set of high quality businesses in the space to invest and stay invested for long. But quality businesses here are now getting 40, 50 operating profit multiples, which are very high. So there is no room for disappointment in these spaces, even though the cycle and everything is very strong from a 3-4 year point of view. A lot of these businesses have gone up 8 times, 10 times from the last time we spoke, maybe 3 years back on this space. So I think we have to be cognizant from a fact that the risk reward from some of these businesses actually drops. And now going below the line in terms of lowering the quality curve in trying to choose businesses is very risky. And that I think is happening in the manufacturing space as we speak.
Okay, Sailesh, on that note, we'll let you go. Appreciate you making time and speaking with ET now today. But shifting focus and welcoming on board Mr. Shalabh Saxena. He's the MD and CEO at Spandana Spurti Financial, joining us on the show. Shalabh, hi, thank you so much for making time and speaking with us. Well, let me ask you about the elephant in the room, and that's the latest report that we got this morning that perhaps Yes Bank is evaluating Spandana Spurti as an acquisition target. Your comments?
So see, good morning to you and all your viewers. This is not the first time it has come. There was a similar item about a couple of weeks back as well. While this is a shareholder matter, but as far as the management is concerned, we came out with a Vision 25 a year back. It lays the roadmap for the next 7 quarters now as we speak. We believe as management that there's a lot of value that the company can deliver over the next 7 quarters until FY25. We are absolutely steadfast in terms of, focused on the delivery, and that is what, the results that you see. So it's too early in my guess from a management point of view, and I think, there's still a lot of journey to be traveled, 7 quarters to be precise, and then we'll evaluate.
Point taken, and I appreciate that you can't comment about investor level issues, but I do understand that Kedara Capital owns around 48% stake. Any conversation that you have had that they're looking at exit, at least you can talk to us about in terms of what their visibility and their commitment is?
When we came out with this document, it was a clear 3-year vision. There is nothing which has changed from the time it was approved, and it was a board approved, roadmap which was laid out. Clearly, and you've seen, I don't need to really explain, but if you see the way the company has kind of progressed over the past 5 quarters that we've taken over, I think, I mean, there's no reason for anyone to believe that, the company is kind of from a value point of view, there's still, I mean, anybody you speak to will kind of say that, there's still a lot of value to be delivered. We've just started the journey. The results are there for for everyone to see. And I think it is too early a discussion to even start. And our position as far as the management is concerned is very clear.
Again, being slightly repetitive with this one, Shalabh, you'll appreciate the curiosity which we are coming with, since there is so much of speculation in the market. But you are, in your best of your knowledge, saying that your vision statement does not involve any kind of an M&A or this kind of an activity. What you've shared with us, it is independently of any inorganic growth.
Yes, and I will add that, anybody who's seen the company progress over the last 5 quarters or the past 5 quarters is completely in sync. And I'm not just talking about the shareholders or the board, I'm talking about the external stakeholders as well. They are convinced that there's a lot of value to be extracted. There's a lot of juice that's still left, which you need to kind of really deliver over the next 7 quarters. So, as far as we are concerned, we are very clear that, it's too early, too soon.
Just to address one more news, Ms. Reddy's ownership in the company has reduced. A lot of experts who've tracked your stock, they've called it as a technical overhang. Do you think her shareholding reduction, the fact that she sold some ownership and she's looking at selling more, is what we understand, wasn't technical overhang?
So, Nikunj, not for me to comment, because, this is change of hands from one to another. There are multiple shareholders, of which she is one. It's her right to kind of work the way that she thinks is appropriate. She came out with her desire a few weeks back, and I think that's the line she's progressing. Not for me to comment.
Okay, but in general, when there is supply in the market for a NBFC or for a bank, it always could be a restrictive factor. I'll tell you why. Because banks and NBFCs, they need constant capital to grow. And when the supply increases comes from a large shareholder, it may just act as a technical overhang for 3-4 quarters. Could that be an indirect disadvantage of when a large shareholder exits?
Look, once again, this is so there are 2 streams which are running. One is the company and how's the company doing. What are we focused on, and what is the delivery that we are doing over the the next few quarters. That's part 1, or channel 1. Channel 2 is what you are speaking about, which is the change of shareholders, etc. So as far as we are concerned, Nikunj, the one does not disturb the other. at best, it will have some impact on the share price is what you're referring to. I am still sticking to the channel 2, which is we stick to what we have to deliver. We have probably delivered over the past 5 quarters, and there's nothing there are economic tailwinds as far as the industry is concerned and the economy is concerned. Being a rural focused microfinance, we are completely completely focused on what is the task at hand for the next 7 quarters, and that's where we are. So as far as we are concerned, we completely focused on the delivery. Nikunj.
Shalabh, hi, morning. And given that you're so focused on the delivery and you believe that there is still a lot of value that you can deliver, walk us through the kind of growth projections. AUM growth of about 35% in FY24 is what you had guided for. You managed to grow by 60% in Q1. Are you going to revisit this guidance?
Look, we've paced our innings, and that's why I keep on, like a broken record, keep on repeating about this FY25 and the Vision 25 that we came out with. As per the Vision 25, we should be at a AUM of roughly about 11,750 to 12,000 crores end of this year, which on a YOY will be roughly about anywhere between 37 to 39% growth. The subsequent year, which is FY25, we will have our AUM from the 12,000 levels will be anywhere between 16,000 to 17,000 crores. So this is part one, which is on the top line. On the profitability part, we came out with the results, 119 crores of profit in quarter 1, and it kind of keeps on. We are still sticking to the guidance. Too early for us to revise. We'll probably think about it another couple of quarters down the line when we see. But all I can say thematically is that all is going fine, both on the top line and the quality of the portfolio point of view. And, I think we are very confident that, at least FY24 and FY25, if all goes well, we should be able to deliver. If not until FY25, probably a quarter ahead.
Shalabh, you're sounding fairly confident, but just wanted to understand, since the easing of the regulations last year wherein pricing caps were removed, how's the pricing of loans improved? And do you think going forward there'll be higher yield loan which will be coming into the books, and that means there'll be more upside on NIMs as well?
So, the quarter 1 results that we came out with, we reported NIMs of 14.2%. Our personal, comfort is in a range of 13.75 to 14%. So we'll evaluate as we progress. Number 1. Number 2, our portfolio yields were about 24%. I think they should remain in the vicinity or thereabouts. So because post the new regulations, we had increased our interest rates, as a result of which, that's the catch up that's happening on the portfolio. So it should be in the range of about 24.1 as far as the portfolio is concerned. So to answer your question, yes, the credit quality, just to kind of complete the narrative, the credit quality is shaping up well. We are seeing good traction on the portfolio side as well. So to answer your question, there's a tick box in all the metrics that we've just spoken about. Things look good at this point in time. We are expanding into the new geographies, the 7 focus states that we had said, and concentration risks, etc., is something that we are kind of actively looking at to ensure that the company is robust from a risk point of view.
Positive note that you're wrapping up with. So thank you for joining in and sharing with us the growth outlook. So like you said, probably like a broken record, but looking at strong growth projections as well down the line. Let's shift gears, and we've got Dipesh Bakshi, who's the CFO and whole-time director at Castrol India, here to talk about their quarterly performance. It's been a flattish margin, but revenues have grown this quarter. Thanks so much for taking time out, and I want to address the margins first up, because for the first half, they have remained at the lower end of the guidance, 23 to 26%. Given that we've seen crude oil prices inch up, what is the outlook on your margins from here on?
Yeah, good morning, and thank you for having me on your channel. Look, I think, in the second quarter, we've delivered a very strong growth, I would say, because we registered a 7% growth in the overall turnover, and, our profits before tax also grew by 7%. So I think overall, it's been a very good quarter. Having said that, what we have seen compared to last year, same quarter, we've had the cost of goods increase by about 8 to 10%. And, post second quarter of last year, we have made interventions in the market in terms of the pricing. Having said that, across our sub-businesses like personal mobility, commercial vehicles, and industrial, the growth has been there. And, this has been a volume-led growth quarter with the demand coming back. Yes, the overall margins in terms of the EBITDA have been in the range of 23 to 25% and towards the lower end. But that's not something that we are really worried about. The market is kind of, in terms of the crude oil, getting softening. And there seems to be some forex pressures as well. But the momentum seems to be with us. And, we look forward for rest of year also in carrying out the momentum.
You said that this quarter there was volume-led growth. So talk to us about what was that volume growth and what do you envisage the volume growth to be like for rest of the year? Are you expecting some improvement from the growth rates that you had in Q1 or it's going to be similar?
Yeah, see, the overall market grows by about 3 to 4%. I mean, that's the market that we are in. And this quarter, as you've seen, we've had a growth in line with the market. And what we expect going forward is, given the momentum, we should aim to grow with or above the market growth. I think the initiatives that we have taken during the quarter have really led to this growth. And you asked the question, what was the reason? And we've come up with new products. We've introduced CRB Essential, which is our flagship brand, and we've introduced a new product in that. SUV market is growing in cars, and we've introduced a product in that as well. So there's been a huge support from a technology interventions that we made and got the products into the market. The industrial segment is growing, so that's something that we are bullish about as well going forward, and that's also something that we did well in this quarter.
Dipesh, the only reason I'm prodding a bit on the volume is because if I have it right in Q1, the volumes were actually down 6 to 7%. This quarter, you talked about a growth of just 3 to 4%, which is the market rate. Going forward for the entire year, do you think it's going to be very, low single digits, 1 to 4% kind of volume growth for the entire year?
I think we need to look at the quarter in perspective of last year as well, second half. Last year's second half, there was a huge increase in the crude oil, and we and all the other companies in the lubricants industry got significantly impacted by that. Forex, which was around 75 rupee dollar, is actually turned out to be around 82, 83. So there has been a lot of pressure on the margins, and that all, in terms of the input is cooling down. Coming to the volume growth, 4% is what the market grows, and I think it's very difficult for us to sort of predict what it is going to be, but our endeavor is always to grow above the market.
Okay, good to know. What about the EV side? Because the parent company already has a portfolio. When will the company be looking to launch EV fluids, and what kind of potential are you seeing from here?
Yeah, look, I mean, EV, we have done a lot actually. So let me just explain that in a bit more detail. Firstly, we have EV products already in the market. It's called EV fluids, Castrol On. We launched earlier this year, and these are used for motor cars. We enjoy very high market share amongst the EV motor car players, which is Tata Motors, BYD, and also MG Motors. Apart from that, we are talking with various OEMs on the two-wheeler side on EV as well. I think the other big thing that we've done globally on EV, because we are part of BP and part of Castrol globally, EV is a very mature market in other parts of the world. We've also made an investment of 50 million pounds in our UK technology center, and that is all about the new battery global research and development. And this is really going to help, come up with new technology, because EV technology is evolving, especially on the battery side. So with thermal management and all the research that's going on, we are very confident that, that is something that we can play in as well. So overall, I think strategically, we are very, very focused. As you know, the car market actually is very, very small right now, but we have products in the market already, and, those products are doing pretty well.
Dipesh, just going back to the point that we started with on the margin, you did highlight the various pulls and pushes which are there, but are you maintaining the guidance for the full year? And if you can help us with that volume figure in terms of what was the million liters that you did this quarter?
So we are maintaining the margin for the guidance that you asked about, because that is something that we've continued to focus on as management. I mean, there will be ups and downs, as you rightly said. The quarter volume is in the range of 58 to 60 million liters.
A last word, there are some, market rumors doing rounds that promoter might be looking at cutting its stake. Anything that you have heard from them?
No, I cannot comment on the market rumors. But let's just step back. I think BP, who's a promoter, is in India. It's in India in various forms. Castor India is one such investment, and they're invested through GeoBP. They are into all of the energy side investments. BP is very bullish about India. That is something that I can definitely confirm. But very difficult to say anything about the market rumors. I would not like to comment on that.
On that note, we'll let you go. Appreciate you joining us and answering candidly all the questions with respect to how the volume and margin is likely to pan out. But on to a big view from the FMCG major. Nestle India CMD says that premiumization is the big trend that they're focusing on. Listen in to that interesting conversation.
Premiumization is happening across categories, whether it is prepared dishes, chocolates, confectionery, coffee, milks and nutrition, health science, pet care, cereals. Wherever we are in, premiumization is becoming an important element because consumers are wanting better quality, better value, better aspiration brands as far as their portfolio of consumption is concerned. That is one part. But that does not mean, and that is the interesting part, that does not mean that small town India or Bharat is also only looking at price point packs and low value packs and low unit price LUPs as they were called. It's not that small town Bharat is looking at that. In small town Bharat as well, there is a premiumization journey that is taking place. They are moving from single packs to multi packs. They're moving from multi packs into premium brands, and you're finding that trend. I mean, if I can go to a Gopiganj and find Kit Kat being picked up by the consumer by the name of Kit Kat, that tells me that the premiumization brand journey has also arrived in those towns. And that is the exciting part of India, that Indians are discovering new tastes, they're discovering new dimensions, they are willing to put some money out for trying it. Now, whether they buy it on a repeated basis and whether they make it part of their repertoire of long-term consumption, time will tell. But today, that proclivity is there. That is what makes it exciting for Nestle.
So if I look at the current setup, the raw material setup, milk prices, edible oil prices, they have been on the lower end, and yet you've managed to expand your margins for the quarter gone by. If inflation starts declining, and if that trend, let's say, persists for another 2 or 3 quarters, then are we looking at a bumper expansion in margins, or somewhere you would be tempted to cut the product pricing?
Look, I think it's a bit premature to talk about whether we can take price cuts or not price cuts. If you look at the commodity scenario today, wheat, while stable, we still don't know what the ultimate outcome will be because it's also determined a lot by what will happen as far as the future winter crop and others are concerned and how the spread of the monsoon will be. Because still, as you know, there has been a lot of erratic behavior as far as the monsoon adequacy in parts of the country is concerned, where some parts have received far more and some parts have received far less. So that's still a phenomenon that is there. Milk, we've had a serious imbalance during the COVID period. The milk herds have been depleted because there was a huge dip in the demand for milk during the COVID period, and now it has started to come back. The milk herd has not been replenished fully. The cost of production has gone up substantially. Feed costs are up, and thirdly, we had the lumpy skin disease that also took its impact on the milk herd. So milk also is something that we have to watch the space because the demand continues to be strong, and the question is now how far will supply be able to beat this? Coffee prices are up anywhere 40 to 60% in the last year and a half. It's looking northwards, not looking southwards so far. So in overall terms, and of course, we have got a whole lot of other products like tomatoes and chilies and lime and various other things which are going through the roof. So food inflation hasn't been fully contained. So I think we cannot take premature calls on saying what the future is going to hold in terms of the pricing equation. As far as today is concerned, the situation is better than last year. That much I can tell you. And part of the reason for the margin expansion is also that the underlying inflation. Going forward, I still have my concerns, though it will be not as serious as it was the last time we met a couple of quarters ago, when in 2022 it was fairly severe, because the 19, 20, and 21 inflation was less than the 22 inflation for the country. This year, it definitely is not near those kind of highs.
Vinod Kargi joins us, Head of Strategy with ICICI Securities. Vinod, great to have you back. Thank you for joining us. While numbers have not been bad, they've not been great as well. Based on the numbers, where do you think the aggregate earnings trajectory is likely to move? Are we in for a big upgrade or nothing exciting?
Yeah, so Nikunj, I think if you go back a bit, the expectations were a little tepid, I think. That's why you're getting more beats as of now. So to that extent, it's a relief that the results are not as bad as earlier expected. That's point number one. Point number two is where the demand is showing up from the results. I mean, we do look at macros, and our thesis was that the investment-related capex cycle and real estate and credit cycle and some of the discretionary consumption was looking good from a top-down perspective. The results are validating that. So I think that is more important, because we know that the investment cycle has a far more larger 2.5 times multiplier effect on aggregate demand on a sustained basis. That's more important, because you could have a quarter or two of some demand from various angles, but it kind of fizzles out. But you have an investment cycle, a real estate, and a manufacturing cycle that gives you confidence that in the future you'll have more sustained demand going forward. So from that perspective, I think the earnings downgrade cycle will not be there. I mean, we have seen the earnings being maintained, forecast basically. And the best thing that's happening right now is that some of the euphoria around the market is becoming a little lesser.
Sure.
So that's good. Yeah.
Right. Yeah, so the euphoria is getting contained, but the big surprise this quarter was, of course, the kind of earnings that we've got from the pharma sector, right? Whether it was a Lupin, whether it was a Dr. Reddy, do you think there is a case to be made for further upgrades of this sector, even in terms of what brokerage and analysts are penciling in terms of EPS growth and target prices?
Yeah, so that was a big surprise. I mean, no one was expecting such results. And typically, we have seen that these changes start with a trickle. I mean, initially, you will get commentaries that, there is some lessening of price erosion, there's some supply disruption. But this can, I mean, if this tendency continues, that there is demand and price erosion is less, and some of the guys there are vacating some of these areas, and it could become more structural. Having said that, the valuations are not extremely cheap, I would say. But this is a very good development. This part of the market, which is export related, along with IT, the softer outlook on IT is getting somewhat kind of compensated by the pharma exports picture basically right now. So that's a good development, because we are comfortable with the domestic demand, but pharma is kind of offsetting some of the impact from IT.
Sure. Since you're talking about IT, let's delve a bit deeper into that, because there's a very interesting note coming in from JP Morgan this morning saying that reality has sunk in for the businesses, but not for the stocks yet, and they are expecting a further downside to the IT stocks. Would you agree with that view?
So if you just go back to post-COVID, the whole digitalization story and the whole excitement, I mean, markets, everyone got overexcited about this whole a new economy where the digital space will be significantly benefiting by all this. And now we see that the reality is that everyone is back to office, the whole physical activities are back. So I think some of this euphoria is kind of resetting. I don't think there is any structural issue with Indian IT services. But resetting itself is painful at times for some time. So I think the uncertainty will remain in the short term. But from a longer, medium term, I don't think this is one of the best sectors that we have in India where we add value to global economy. So I don't think there is any structural issue. But as I said, short-term reset is on the cards right now.
Could be that short-term reset. See, structural issue when AI is getting adopted, everybody is confused. December Infosys guidance was different and their July guidance is different. So obviously there is an issue which they're struggling with. I mean, a company which was growing at 10-12% is talking about no growth.
Absolutely. I mean, so AI is something which is, no one understands that well how much it will have. I mean, there are proponents who say that AI will actually benefit these companies over medium to long term. The short-term reset will obviously be more painful, but no one clearly knows. I mean, is it structurally positive or negative? But I would hazard a guess that over a longer period, disruptions in the IT sector have all largely helped their productivity improvement overall. But as I said, this along with the digital thing, these are shorter term resets, which will make it very uncertain, I think, for this sector.
All right, Vinod, appreciate your time. So glad you could join us. Markets, meanwhile, what do we have? You want to look at auto stocks because auto dispatch numbers, Escort numbers, Maruti numbers, everything's come out. Let's understand the positioning of the sector. If there is one sector which has turned out to be the sector of the year so far, I think it's clearly autos. After 2 years of semiconductor issue, COVID lockdown issue, that sector finally seen some revival. The SUV market is throbbing and the CV market is in some kind of an upturn. But our market's pricing in a couple of years of good solid earnings, or there's still some more headroom left for auto stocks to expand. Kumar Rakesh, India analyst, IT and auto with PNB Paribas joins us now. Kumar, good morning. Thank you for joining us. Why have auto stocks done well this year? And do you think the party will continue?
Good morning, Nikhil. Thank you for having me on the show. If you look back over the last 4-5 years, it has been very challenging for the auto industry. Various regulatory norms changed, which increased the prices. The demand collapsed because of the COVID lockdowns. And then the commodity prices dramatically shot up, which impacted the margin. So from the auto stock perspective, a lot of various headwinds had been consistently hitting the industry over the last 4-5 years. Now it appears that most of those headwinds are largely behind. The regulatory challenges are behind and the price has largely been absorbed by the consumers. So it appears that now we have a clear runway on the demand and margin trajectory, and that is something which you would see started showing up in the stock price movement as well. Through this year, stock prices of auto companies have significantly expanded, and especially over the last 2-3 years as investors are gaining more comfort on the demand as well as margin side of the equation. That being said, looking at some of the valuation, it has definitely stretched, and now possibly would be the time to getting a little more selective and picking up the auto stocks incrementally from here on. There are still some pockets which are not showing very resilient demand, and that could be two-wheeler area. Passenger vehicle industry is quite robust, and commercial vehicle industry is seeing a strong upcycle that should continue for a year or two at least. In that context, being more selective in the auto stock from here on would be a more prudent choice.
That you are being selectively positive about then, Kumar?
Sorry, I didn't get the question.
My question is, so which are these stocks that you are selectively positive about? What's your pecking order?
Sure. So the companies which are more exposed to the passenger vehicle segment, commercial vehicle and global auto side are the ones which we are more positive on. That would be Maruti, Suzuki, Tata Motors, Ashok Leyland, such names. The global auto industry also is seeing a very strong recovery despite the macroeconomic challenges which we hear. The micro data which we track on a regular basis are quite supportive of the global auto demand recovery. That would be positive for the companies which are exposed to the global auto. demand on also the auto ancillary companies, which are far more exposed to the global auto side, and those would be far more preferred pick.
For Tata Motors specifically, do you think there is a upside risk to estimates further, or do you think the best has already been priced in?
For the last couple of quarters, the company has been consistently surprising us positively on their performance as well as on the guidance side now. If the company continues to enjoy the low discounting and the realization benefit which they are currently, there is definitely a positive upside, because consensus now is gradually moving towards the guidance which the company had earlier given. And there is a chance that the company could revisit those guidance and possibly upgrade those guidance with the second quarter result. If that were to happen, there is an upside risk.
I'll specifically talk about the trend in the passenger car market. The aggregate market is growing at 5-6%. SUVs are growing in double digits. Sedan is not growing. Do you see that companies like Maruti, which also have a big presence in sedan market, they actually could be into a rough weather? Because, okay, you will sell SUVs, but your sedan, if it is not selling, it will have impact on margins. It will have a demand on operating leverage. And if there is a discount phenomenon at factor, then obviously the realizations will plummet.
Yeah, you're right. There is definitely a challenge of two different segments of the industry performing absolutely diagonally opposite to each other. SUV space definitely is a high growth segment. But the good point is that a large part of these challenges which you referred are already reflecting in their earlier performance. If you look at their market share, it has already significantly come down from more than 50% to almost 42%. And that part of the transition which you are referring to is already reflecting in the market share performance. And now they have started launching SUV models. So there is a chance that they would be outperforming the industry growth, and they themselves are targeting a market share leadership within SUV. If that were to happen from a low market share where they currently are relative to their recent history, there is a possibility that they continue to gain market share. May not be able to achieve where they were or entirely recoup their lost market share, but the market share gain possibility driven by the recent model launches is definitely there. And if that were to happen, you'll see the volume improving, and that should have a benefit on the margin as well. But the point which you made about the discount is definitely relevant. And that is something which needs to be tracked closely, because in the result which they announced yesterday, the discounting increased. And if that trend continues, that is something which can possibly start impacting on the margin recovery side. And hence, we'll be closely watching that. In the first quarter, they were able to absorb that increased discounting. Their margin adjusted for one-off were largely flattish on a quarter-on-quarter basis. So hence, not a material impact so far, but definitely something to closely watch out for.
Kumar, when it comes to the entire two-wheeler space, who do you believe is likely to stand out? You did speak about sluggishness here. There have been new launches that we've seen taken place. The Hunter 350, for example, that took place recently by Eicher. What's your outlook as to who is likely to emerge triumphant within within two-wheelers?
So the overall two-wheeler industry will likely see a muted growth in our opinion. A couple of reasons for that is the significant price increase that has happened in the two-wheeler industry, and also the high penetration the industry is now reaching to. That would imply that the overall industry would likely be muted. And you add to the mix the EV disruption, which will also eat into some of the demand, incremental demand for the industry. The companies which can potentially be slightly less impacted could be a company like Bajaj Auto, which is relatively far more diversified. It has three-wheeler business and export as well. And Eicher Motor, the near term could be challenging with the increased competition in its space. But from a longer term perspective, the Eicher could be relatively lesser impacted compared to others.
Welcome. I really appreciate your time. So glad you could join us with your views. What do we have? Got a nice little rally, I think, in some of the construction stocks. BL Kashyap, Ahluwalia, Dilip Bidcon, some of these construction stocks in a sense are really rediscovering their lost mojo. Ahluwalia may not be doing exciting things today, but of late it has been a ranked outperformer. Similarly, throw in a BL Kashyap, you may talk about, I just saw Dilip Bidcon, some of these stocks which are pure construction companies. I mean, when I say really are in the business of constructing roads, buildings, capacitor. I mean, it's a stock where Mukul Agrawal has invested. Vikas, good old Vikas Kemani has taken a preferential issue. That space is doing rather well. So this is, I think, a sectoral churn. I think it's more than a deep swell now, because this is one sector where massive consolidation has happened. And when typically consolidation happens, the existing players, they tend to gain land market share when the cycle turns. And the construction cycle has turned for sure. And it normally stays warm in the run-up to state elections, big state elections, which Chhattisgarh, Madhya Pradesh and Rajasthan, big states are going for polling this year, and then the central election next year. Sumit is going to now tell us the impact of MSCI inclusion in terms of the specifics, and the review, I think, is in the month of August already due, right, Sumit?
11th is when MSCI will be announcing the changes for the August review, and the adjustment date will be August 31st. But the stocks that would be getting included or excluded from the MSCI would depend on the closing date or the cutoff price in the last 10 business days of July month. So based on that cutoff date, IFL has come out with this list, and they're saying that Astra Cummins India is expected to be included in the MSCI index, and the inflows would be around $193 million, which is nearly 14 times its 20-day average volume. But from that, there is Astral, HDFC, AMC and PFC, which could also see inflows in the range of around $150 to $190 million, which would be nearly 5 to 12 times their average daily volumes. Then there is Ashok Leland, IDFC First and Polycab, which could also get included in the MSCI index, and the volumes or the flows could be in the range of around $150 to $190 million, which is nearly 2 times to 5 times their average daily volumes. Now for Polycab, the brokerage is also specifically saying that the inclusion of this stock would specifically depend on which date has been considered as MSCI for inclusion. As of July 18th, Polycab has less chances of getting included in the MSCI index. Now on the exclusion side, ACC has always been one of the top contenders to be excluded from the MSCI index, and if that happens, then there could be an outflow of around $90 million. With Jubilant Foodwork is a new name that has been coming in, and if the stock gets excluded from the index, then the outflow could be close to $133 million, which is nearly 11 times its average daily volume. Now apart from these large cap names, there are a host of small cap names also which could get included in the MSCI small cap index. Now the inflows would not be a big amount, max to max around $4 to $5 million, but compared the volumes that could come in because of this inflows could be on the higher side. Some marquee names are Gateway Distriparks, Vesuvius India, Aluwalia Contracts, Apcotex, Moltec Packaging, Green Lamb and Voltime Transformers.
Right, thanks very much, Sumit, for giving us the updates on the MSCI August review. Another order win, by the way, for L&T. Tell you what, we'll take a very quick break. Be right back as we connect with more market voices and corporate guests.